I'm talking today to Gerry Ferguson, who's fund manager of the SWIP Property Trust. Gerry, what have been the major changes or influences in the UK property market in the first quarter of 2010?
The main changes really flow from what happened over the last quarter of last year, 2009, when you saw a dramatic increase of investor money into the UK property market, and particularly into the open-ended funds such as the SWIP Property Trust. Numbers which I've seen suggest that there was around £3 billion went into the sort of open or pooled-ended side of the UK fund. And when you put that in perspective, that the last high number was 1.6 billion, it just sort of shows you the inflows over the last quarter. And clearly, the duty now and the responsibility of fund managers is to invest that money wisely. So what we're seeing now is a renewal of investors looking to buy property, and the market is now becoming quite competitive.
How has the SWIP Property Trust performed within the present market?
We've performed very well on a number of counts. Firstly, our performance now has moved into very positive territory. We've been returning around 1.5% to 2% per month, which is excellent. And more importantly, we've also continued to invest into the bricks and mortar sector of the UK property market. Over the last quarter of last year, we invested around £300 million, and over the first 2 months of this year, we've invested £150 million.
Now, I gather the investment powers of the Trust have changed recently. What does that mean?
Well, in broad terms, the powers have enabled me as the fund manager to invest into a wider range of asset types than previously I could do so. Why have we done that? Well, there have been a number of reasons. Particularly is to manage liquidity, moments of stress within liquidity, both in terms of excess liquidity, which we have at the present time, because we have a cash position of around 30%, and also at moments when investors are seeking liquidity to meet redemptions.
And how will these new instruments be used within the Trust?
There are two main goals for these new instruments. One is, as I mentioned a few minutes ago, to provide liquidity. The second, and equally important, is to provide a higher return to investors than cash, and one which is more correlated to the underlying property market. This will manifest itself in terms of the overall composition of assets within the Trust. And if I could maybe just give you the framework of how these are going to sort of change over the coming sort of months. We see the long-term position of the Trust as having a direct property exposure, i.e. a bricks and mortar property exposure in the range 75 to 85%. The other proportion of the fund would be invested into a balance of asset types, and these would include straightforward cash instruments, but also perhaps some property derivatives, property REITs and property-related fixed income bonds. The overall benefit will be not only liquidity, but I have estimated that it will probably raise the income return by the fund by around 50 to 100 basis points to investors. So there will be an immediate benefit when we have, as I mentioned a few minutes ago, an excess of liquidity, but also will be a benefit in times when we are in a much more stable position. We'll be running a sort of direct property proportion of around sort of 80 to 85% in the fund.
So is the Trust still able to invest up to 100% in property?
Well, yes, the fund can still invest 100% in property, but clearly if it did that, it couldn't offer the daily liquidity which investors are seeking. And as I said a few minutes ago, when you look back at the inflows and outflows into the open-ended property funds over the last 5 years, there have been 2 or 3 times of quite dramatic volatility in that. And until we move to a period of more sort of consistent flows into the fund, we must set our strategy in order to be able to deal with any volatile movements.
So what sector or regional trends do you think you'll be looking for in the coming months?
Well, at the present time, the fund is slightly overweight in the retail sector, which helped its good performance last year, and overweight in industrials, which traditionally gives it the high income return. So over the next 12 to 18 months, we're looking to rebalance that by moving into the office sector, and particularly focusing on the central London market, where the fund has been underweight. But we're now beginning to see the sort of the early signs of rental growth within that market, and clearly we're looking to position the fund so it can benefit from these rental growth over the next couple of years.
To get to where you are now, can you give us some examples of some recent activity?
I can give you two very good examples which shows you the type of properties that we're investing in. One, which is not too far from here in Edinburgh, was in the High Street when we purchased just before the end of the year the Missoni Hotel complex. That was a 5-star hotel under the Missoni brand, but let to Radisson, the major European hotel operator. In conjunction with that, there's the new Bank of Scotland Mound branch and a number of high-class restaurants. That amounted to just over £41 million, 20-odd year leases and delivering a yield of 6%. Some ways at the other end of the spectrum in some ways was an entertainment centre in Croydon, which was a cinema, a number of public houses and a Virgin Sports Centre, again with long leases. We purchased that recently to deliver a yield of 7.75%. So we're focusing very much on delivering income to investors because that's where we believe the majority of property returns are going to come from over the next couple of years.
And can you give us some examples of what you're planning for future activity?
Yes, well, I've mentioned a few minutes ago that we're focusing on the Central London office market. Well, we've just put under offer a few days ago a large Central London office building, multi-let, offering us opportunity, A, to tap into the rental growth prospects, which I mentioned we see coming through in Central London, but also opportunity to manage and re-gear leases and therefore add value. That's around £65 million and is delivering an initial yield of over 6.5%. Again, adding to that income flow, which I mentioned a few minutes ago.
Now, last time, Gerry, we discussed your vacancy rate, which is still low compared to the IPD benchmark. How are you still managing to maintain this?
Well, we're managing principally to maintain it through two ways. One is the majority of the investments which we are buying are fully let at the present time, although we have bought some where there have been partial vacancies. And also we have been working hard to let the existing vacancies within the portfolio, and indeed recently just let a unit in our Huddersfield Retail Warehouse Park to Mothercare, a unit which was one of the first which suffered from the retailer demise 12 months ago. However, we are in the fortunate position, as you say, of having this very low vacancy rate, and what that does is it enables us to buy properties which perhaps have existing vacancies, but the opportunity we have is that we can price in the holding costs of these and any capital expenditure, and of course just choose the market where that vacancy occurs. And clearly, we're only going to do that where we're confident that we will be able to re-let the property in the improving market conditions which we see in 2 or 3 years' time.
Looking ahead then, what do you expect to see from the UK property market during the second quarter of 2010?
We think capital values will certainly continue to increase over the second quarter and indeed into the second half of 2010, albeit that rate of increase will probably begin to slow down. Looking at what's been happening over the last couple of weeks, I've certainly noticed a lot more property coming onto the market, and the natural effect of that is that capital value growth would begin to slow down.
So do you think we're perhaps past the worst challenges in UK property for now?
I think we've passed the worst, but I think we certainly still have challenges ahead. Property fundamentals, rental growth, occupational demand is still very fragile at the present time. And of course we have the forthcoming election and the unwinding of quantitative easing, and these are two very major events, and it's very difficult to forecast what effect they're going to have on the UK economy, never mind the property market as such. And I think for that reason we still remain cautious at the present time in terms of the sort of assets we're looking at to buy for the fund.
Thank you very much, Gerry Ferguson.
Thank you.